Happy Friday, everyone. I'm back, and I know you're ready for the weekend because I know I am. Thanks for joining me again today as we continue our April Weekly Market Insight series, which comes directly from our capital markets trading desk right here at SunWest Mortgage Company. So let's get right to it. It was a rough week for U.S. stocks and treasuries as strong economic and job data indicated delay in interest rate cuts due to sticky inflation. On Wall Street, the three major indices were on track for a losing week and were lower for the month of April in sharp contrast with their strong first quarter. The 10-year Treasury yield has surged to its highest level since November, topping 4.6% as markets face anxiety over higher for longer interest rates. Traders are now pricing Fed rate cuts for November, while some analysts suggested that the Fed may need to raise rates once again. In several speaking engagements, Federal Reserve officials have undertaken a more hawkish tone, indicating that high interest rates are here to stay. On Tuesday, Fed Chair Jerome Powell commented that policymakers need to see more progress on the inflation front and that it will likely take longer than previously anticipated for the central bank to cut interest rates. Cleveland Fed President Mester added that interest rates can be held steady, while New York Fed President Williams reiterated that there's no rush to lower interest rates and economic data will determine the timing. Commerce Department data showed that American consumer demand remains resilient despite inflationary pressures. Retail sales in March were up 0.7%, almost doubling the expectations of 0.4% gains. Excluding auto and gas sales, sales were up 1.1%. Online sales had the biggest growth, increasing by 2.7%. The February figures were revised upward to 0.9% from 0.6%. A strong job market and rising wages have fueled household spending and may cause inflation to stay for longer, further delaying interest rate cuts from the Federal Reserve. According to the National Association of Home Builders Market Index report, home builder sentiment remained at 51 this month, in line with analyst expectations and unchanged from March. The unchanged reading halts a 4-month advance by the Housing Market Index, which had reached its highest level since last July. After surging a revised 12.7 in February, new home construction in the U.S. disappointingly fell in March. Residential housing starts decreased 14.7 last month to a 1.3 million annualized rate, its lowest since August 2023. Building permits, which point to future construction, fell to 1.4 million from a revised 1.5 million the previous month. And on Thursday, the National Association of Realtors said that sales of previously occupied homes fell 4.3% in March to a 4.2 million rate, down from February's 4.4 million. It was the first monthly decline since December. Sales were also down 3.7% compared to March of last year. The average rate for a 30-year fixed loan reached 7.1% last week, its highest level since December 2023. Even with interest rates rising for the second straight week, mortgage applications increased 3.3% for the week ending April 12th. The MBA Market Composite Index showed that refinance applications were up 0.5% from 1 week earlier and were 11% higher than the same week last year. Purchases increased by 5% from the previous week, but were down 10% when compared to the same week a year ago. U.S. applications for unemployment remained historically low for the week ending April 13th. Initial jobless claims were unchanged and held at 212,000. Continuing claims were little changed at 1.8 million for the week ending April 6th. Well, that's it for this week. Of course, if you like this video, please hit that like button. And as always, to stay updated with our news, join me again next Friday. Our trading desk will have the latest information about our pricing incentives, so stay locked in. Have an awesome day, everyone, and an even better weekend. Buffy, out.